Welcome back to Investing Talk Podcast. We're here to help you navigate the dynamic world of investments, really cutting through the noise to get to those core insights. Today, we're tackling a question I suspect many of you might be asking yourselves, especially in this market. Is reAlpha Tech a good time to buy now? We're going to really pull back the curtain on the company's recent performance, its financial health, and what its future prospects look like. And this is all based on the very latest information we've managed to gather. It's quite an intriguing case study, isn't it? You've got this high-growth meeting, some really significant challenges. So reAlpha Tech, for those maybe not familiar, it's a technology-driven company. They're focused on real estate platforms and services. Our mission today is to uncover the most important insights from our research. We want to help you understand whether this stock might fit, your investment strategy right now. Think of us as your guides, helping you piece together this puzzle.
Yeah, and it's crucial for us to understand how reAlpha Tech actually positions itself in this, well, let's face it, bustling market. They're leveraging technology, data analytics, specifically in the short-term rental market, while also working to transform traditional home buying platforms. It's definitely a sector brimming with innovation and, frankly, a lot of investor buzz. But as always, the headlines, they only tell part of the story. Our job is to look beyond that initial excitement and really delve into the nuts and bolts of their actual performance.
Absolutely. And before we really jump into the numbers and the details, just a quick request. If you find value in our discussions, please take a moment to subscribe, like, and comment. We really thrive on your engagement. And hey, if there's a specific company you'd like us to look into next time, leave a comment below. We genuinely love hearing from you. Okay, so let's begin our exploration. Let's really try to understand the company itself first. Our information describes reAlpha Tech as operating through two primary segments: platform services and rental. Could you break down what each of these entails? And crucially, how do they actually make money?
Absolutely. So you can think of their platform services segment as kind of the brain behind their real estate strategy. This is where they're leveraging sophisticated AI, data analytics, to gain insights into the short-term rental market. They're identifying high demand areas, optimizing pricing for, say, maximum occupancy, and even offering property acquisition services to clients looking to invest in this space. They monetize this bit through things like data subscriptions, advisory fees, and potentially commissions on property acquisitions.
Okay, the data and advisory side, got it.
Then the rental segment, well, that's more the boots on the ground operation, as you might guess from the name. This is where reAlpha Tech is directly involved in managing and operating short-term rental properties themselves. They handle everything: guest bookings, property maintenance, ensuring a seamless rental experience. Revenue here comes directly from rental income, guest stays, and the core strategy underpinning both. It's using AI to disrupt those traditional real estate processes. Everything from home buying through their mortgage subsidiaries all the way to optimizing those short-term rentals. They're aiming for a significant foothold in this AI-powered real estate tech space, really hoping to carve out market share by improving efficiency and offering, truly innovative solutions.
So it's kind of a two-pronged approach then, providing the intelligence and infrastructure on one side and then actively participating in the rental market on the other. That makes sense for a tech company trying to integrate vertically, I suppose. But now let's talk about the numbers, because this is where things get, really eye-catching. Our sources highlight what looks like absolutely explosive revenue growth. I mean, in the first half of 2025, revenue shot up to over $2.1 million. That's a colossal leap from just over $82,000 in the same period last year. That's more than 2,500% growth. They also generated $1.14 million in gross profit. How do we even begin to make sense of a surge like that?
That revenue growth is, it's almost unparalleled. It immediately grabs your attention, no doubt. It suggests incredibly rapid scaling, potentially strong market adoption for their services. However, and this is a big however, this is where we have to connect that impressive top-line growth to the bigger picture, specifically their overall profitability. See, despite that substantial revenue increase, the company sustained significant operating losses. For that same 6-month period, operating expenses totaled over $7.6 million. That led to a net loss from continuing operations of nearly $7 million. And if we zoom in on just Q2 alone, revenue was up a staggering 1,909% year over year to about $1.3 million. Impressive, right?
That's still huge.
But the net losses, they widened further to approximately $4.1 million. So yes, the top line is surging like a rocket, absolutely. But the bottom line is very much in the red, and those losses are actually getting bigger.
Wow. Okay, so a massive top line increase, but a widening net loss. This sounds like a classic growth at all costs playbook, doesn't it? What does this situation tell us about their financial health and, maybe more importantly, the sustainability of this really aggressive growth trajectory?
You've hit the nail on the head there. This signals what we often call a cash burn situation. Plain and simple, they are spending significantly more than they are bringing in. It indicates a clear strategic focus on aggressive growth, scaling operations over, immediate profitability. Now, this isn't necessarily uncommon for early stage tech companies trying to disrupt a market. You see this. Think of it like a startup pouring fuel into a rocket for launch. It's necessary for liftoff, sure, but it's completely unsustainable if they don't eventually achieve, self-sustaining propulsion in orbit, which means profitability.
Right. And to get to orbit.
Exactly. So for investors, for you, the real insight isn't just if revenue is growing, but how sustainably it's growing. And maybe what specific operational milestones will signal a pivot towards financial discipline, rather than just burning through cash, hoping for some breakthrough.
That makes sense.
It's also worth noting that their gross margins fell. They went from 71% down to 50% year over year.
Quite a drop.
Yeah. Now, this drop can happen during rapid scaling, as new costs or maybe less efficient operations come online. But declining margins alongside increasing losses, that's definitely a metric to watch very closely. It suggests that even the revenue they are generating isn't as profitable as it once was.
Okay, that distinction between aggressive growth and potentially unsustainable spending is critical. Now, expanding on that theme of financial health, our sources point to some notable shifts in their capital structure during Q2 2025. The number of common shares outstanding increased over 52 million by June 30, 2025. That's up from about 45 million at the end of 2024. Plus, they completed a warrant inducement that generated about $3.1 million in gross proceeds.
Yeah.
What are the implications of these capital moves for you, the potential investor?
Well, putting this into the broader context, the increase in common shares outstanding, especially alongside those warrant exercises, it points directly to potential shareholder dilution.
Right.
The warrant inducement, just quickly, it's a specific action where a company incentivizes existing warrant holders to convert their warrants into common stock, usually by offering a slightly better deal. While this does bring in capital, like you said, $3.1 million gross, here it comes at a cost. It increases the total number of common shares floating around. So for you, as an existing shareholder, this effectively means your percentage ownership of the company might decrease, even if the overall company value stays the same. It's like, cutting a pie into more slices. Each slice just gets smaller.
Got it. Less pie per person.
Pretty much. Furthermore, our sources reported a $1.96 million Level 3 liability valuation. Now, this term, Level 3 liability valuation, it's important. It means the company is using internal models and assumptions to estimate the fair value of some complex financial items. They're not relying on clear, observable market prices.
Okay, so it's based on their own math, essentially.
Right. And for you, the investor, this introduces a degree of uncertainty. These values can be less transparent, harder to verify independently. It's just a signal to tread carefully in that area.
Okay.
And perhaps most critically, their cash reserves fell sharply year over year, down to just over $587,000 as of July 2025.
Wow, under 600K.
Yeah. Now, when we consider that against the backdrop of their reported operating expenses, remember, $7.6 million for just 6 months, that cash balance is incredibly low. It highlights ongoing, pretty pressing capital needs.
Definitely.
On a slightly brighter note, they did repay a previously outstanding note in full, so they eliminated that specific debt obligation. So they cleared one liability, which is good. But the overall cash position remains a significant concern, especially for a company burning cash like this.
It really sounds like they're juggling multiple balls here, raising capital, managing debt, funding aggressive growth, all while operating with a relatively thin cash cushion. This brings us to their strategic moves. In June 2025, Mike Lagozzo was appointed CEO. The founder, Giri Devanur, moved to executive chairman. Plus, they introduced Claire, which is a proprietary AI-powered loan officer assistant. What's the strategic significance of these moves for reAlpha Tech's trajectory?
Well, a key takeaway here is the clear, maybe intensified push towards scaling operations and really deeply embedding AI into their core functions. The leadership transition, bringing in a new CEO while the founder shifts to executive chairman, that often suggests a focus on operational expertise, someone to manage that aggressive growth and execute a perhaps more refined vision.
Okay.
It's a pretty common move for companies transitioning from that, founder-led startup phase to a more mature, operationally driven growth phase.
Right. shifting gears.
Exactly. And then there's Claire, their AI platform. Now, this isn't just a fancy buzzword. Claire is designed to automate mortgage document processing. The potential they're citing is reducing manual workload by about 60% and cutting the time spent per loan file by 20%.
That sounds significant.
It is significant. This is critical for improving operational efficiency, especially for a company aiming for high transaction volumes. It directly addresses the challenge of scaling without proportionally increasing human capital costs, which, as we've seen, is essential for a growth-focused tech company with high cash burn. It really speaks to their commitment to technology as a core differentiator, trying to use that AI to drive down those operational expenses we were just talking about.
And beyond just the technological integration, they're also physically expanding their footprint, aren't they? Our sources mentioned they continue to expand their national mortgage brokerage and recently entered the Georgia market in August 2025. How does this fit into their overall growth strategy, especially considering the financial picture we just discussed, that tight cash situation?
Exactly. The expansion into a dynamic market like Georgia, which, by the way, saw over 125,000 transactions in 2024, it signals a broader geographic growth strategy. They want to capture more market share. Their subsidiaries, reAlpha Mortgage and GTG Financial, these are key drivers of their recent revenue through transaction fees and commissions, so expanding their reach geographically. It directly correlates with their revenue generation ambition.
Okay, more markets, more potential fees.
Right. All these moves are designed to increase their market share and operational scale. However, and this brings us back to the financials, this raises an important question for you as an investor. Given their current cash burn, given the Nasdaq compliance concerns we'll get to, how sustainable is this aggressive expansion?
Yeah.
Is it a strategic necessity to achieve critical mass? Or could it be perceived as maybe a risky overreach that further strains their already tight financial resources? It's a really delicate balance. They need to grow to achieve profitability eventually, but growth also costs money they don't seem to have a lot of right now.
That really is the tension, isn't it? On one hand, you need to expand to justify the tech investment and get scale. But on the other, every expansion costs capital they're short on. Now, let's pivot to some of the more challenging news. Our sources indicate that reAlpha Tech received a letter from Nasdaq's listing qualifications staff back in May 2025. It was regarding compliance matters. And, maybe related, they're considering a reverse stock split. What does this imply for the company and for its investors? This sounds serious.
This is where we need to pay very close attention, yes. It's about stability and perceived value. A letter from Nasdaq regarding listing compliance, and then the consideration of a reverse stock split. These are indeed significant red flags for investors. You don't want to see these. Such a letter often indicates that the company's stock price has fallen below Nasdaq's minimum bid price requirement. That's typically $1 per share. Or maybe there are other compliance issues they need to address to maintain their listing.
Okay, so falling below the dollar mark is a common trigger.
Very common. And the consideration of a reverse stock split is a frequent response to this exact problem. It basically consolidates existing shares into a smaller number of higher-priced shares. So, for example, a 1-for-10 reverse split would turn every 10 shares worth, say, $7.50 into one share worth $5.
Okay, so the price per share goes up, but you have fewer shares.
Precisely. While it mathematically boosts the per-share price, maybe helping them maintain the listing requirements, it doesn't change the company's overall market capitalization. It doesn't change its underlying fundamental value one bit.
Right, it's just shuffling the deck chairs.
In a way, yes.
Yeah.
And putting this into the broader context, the key insight here for you is the ripple effect. A reverse stock split, while mathematically neutral, often triggers a psychological blow to investor confidence. It can signal underlying financial distress rather than fundamental health. It's frequently viewed as a measure of last resort just to stay on the exchange. It rarely solves the core operational or financial problems that led to the low share price in the first place. And it can certainly deter some investors who see it as a sign of trouble ahead. Not a good look.
So it's definitely not a fix for the underlying issues, more like a Band-Aid to try and stay listed with potential negative psychological impacts on the market. That certainly complicates the picture for potential investors. Okay. Given all this, what can we look forward to? Are there any upcoming events that might influence reAlpha Tech? And what are the most significant risks still really looming on the horizon?
Okay, let's start with the upcoming catalysts or sources mentioned. First up, there's the Q3 2025 earnings release. That's expected in October, and it will be absolutely crucial. This will be the first major opportunity to see if their AI-powered automation, like Claire, is actually translating into sustainable operational efficiencies. And crucially, are they improving cost discipline? Can they manage those gross margins we talked about earlier?
Okay, Q3 earnings, big one.
Huge. Then, in November, we have ETF quarterly rebalancing. That could see shifts in institutional holdings, maybe some forced buying or selling, and potential institutional buying activity in December could signal renewed confidence from larger players, which might provide a boost. Long term, there's also a 2022 stock plan that allows for annual increases in share reserves through 2032. That could influence future capital raises, maybe more dilution down the line.
Yeah.
However, for you, the investor, we also need to consider the current market sentiment. Now, despite some recent share surges, it closed at $0.98 on September 10th, up from $0.49 earlier. The valuation metrics are concerning. It shows a really high price-to-sales ratio of 40.93.
40 times sales, wow.
Yeah. To put that in perspective, investors are essentially betting more than 40 times the company's annual revenue on its future potential. That really points to speculative optimism, doesn't it?
It sure sounds like it. Betting on the come.
Exactly. Investors are heavily betting on future potential rather than current financial metrics, and perhaps even more concerning is the reported negative equity.
Negative equity. What does that mean exactly?
It's a significant red flag. Negative equity means the company's total liabilities actually exceed its total assets. It's like having more debts than things you own. It indicates a really precarious financial foundation.
Okay, a 40x price-to-sales ratio and negative equity. Those are indeed stark numbers, especially against that backdrop of impressive revenue growth, but also the losses. So, drilling down, what would you identify as the most significant immediate risks for potential investors considering reAlpha Tech right now? If you had to pick one or two things to watch like a hawk.
Okay, well, the company faces critical, multifaceted challenges. First and foremost, those significant profitability issues we keep coming back to. Operating losses vastly exceeding revenue growth, that high cash burn rate, remember, over $7.6 million in operating expenses for just 6 months, it raises fundamental sustainability concerns. How long can they keep that up?
Right. The clock is ticking on the cash.
Precisely. They're losing money quickly to grow, and the big question is how long that can continue without needing significant additional capital. Second, the ongoing Nasdaq compliance concerns. The very real potential for a reverse stock split or even, worst case, delisting. That presents a direct threat to the stock's liquidity and, of course, investor confidence.
Okay, profitability and listing status, top two.
Definitely. And beyond the company itself, remember, they operate in the real estate tech sector. That space faces inherent regulatory uncertainties, market cyclicality. Real estate can be very volatile, up and down, and intense competition from both established players and other well-funded startups. Plus, broader economic conditions, especially those affecting real estate and mortgage markets, like rising interest rates or a housing downturn, those could also significantly impact their performance.
So internal and external pressures.
Absolutely. If I were watching one data point above all others, it would be their cash runway. How much longer can they operate at this burn rate without needing significant additional capital? And crucially, can they secure that capital without excessive dilution? That will be the key indicator of immediate stability, I think.
So it's a real tightrope walk with very little room for error. They need to secure more capital, become more efficient, and execute on growth all at the same time. Now, our sources also included some, let's say, intriguing rumors and speculative catalysts. We're hearing whispers of potential partnership with a major real estate platform, expansion into additional Sunbelt states like Florida and Texas, maybe even a strategic acquisition targeting mortgage tech. And there's also speculation about a possible secondary equity offering. What's your take on these possibilities? How much weight should we give them?
Well, look, these are certainly exciting possibilities. They could provide significant boosts if they materialize. A major partnership or expansion into high-growth markets like Florida and Texas, that could accelerate adoption and market share gains dramatically, maybe validate their AI-driven approach. A strategic acquisition could potentially vertically integrate operations, enhance their tech stack, provide competitive advantages, all good things.
Right, game changers potentially.
Potentially. However, and this is absolutely crucial for you, the listener, you have to remember that these are, right now, unsubstantiated rumors. They carry absolutely no guarantee of happening, and investment decisions should never be based purely on speculation or whispers.
Very important point.
While a partnership with a major platform sounds transformative, we have no concrete evidence. It's just talk at this stage. And the speculation about a secondary equity offering, while it's still just a rumor, it also kind of aligns with the company's significant cash burn and their growth ambitions, doesn't it?
Yeah, it fits the narrative of needing cash.
Exactly. It suggests a potential need for further capital, which, if it happens, would almost certainly lead to more dilution for existing shareholders. We talked about that earlier. So it's really important to separate confirmed news from hopeful speculation, especially when you're looking at a company with their current financial profile. These rumors could be a double-edged sword. Exciting if true, but misleading if they don't materialize and maybe hinting at further dilution even if they do need the cash for something positive.
That's a very important distinction to make. Okay, so as we bring all of this information together now, what does this comprehensive picture really mean for someone considering reAlpha Tech right now? We've seen incredible revenue growth, innovative AI solutions, but they're balanced against substantial operating losses, significant cash burn, a tight cash position, and those Nasdaq compliance issues. It's quite the mix.
Yeah, it really is. Putting this into the broader context, the overall assessment from our sources rated the company a 3 out of 10.
Only 3 out of 10.
Yes, explicitly highlighting it as a high-risk investment. And that's for both short-term trading and long-term holding. This rating is largely due to those fundamental challenges we've discussed, the profitability issues, the ongoing cash burn, the potential delisting concerns. Your outlook on reAlpha Tech, if you're listening, it hinges entirely on whether you believe the company can successfully execute its AI-driven scaling strategy while simultaneously restoring profitability and aggressively managing that cash burn.
That's the crux of it, execution.
Absolutely. It requires a really delicate balancing act between that aggressive expansion they seem to need and fundamental operational and financial discipline, which they desperately need to show. For you, the investor, it truly is a high-stakes bet on future execution. Very high stakes.
It certainly sounds like a company with immense innovative potential, no doubt about that, but also extremely high volatility and significant hurdles still to overcome. The journey ahead for reAlpha Tech really looks like a tightrope walk between leveraging technology for growth and achieving genuine financial stability. Well, thank you for joining us on this exploration of reAlpha Tech. It's a prime example, isn't it, of a company navigating rapid growth in a dynamic sector, facing both exciting opportunities and, well, considerable risks. For you, the investor, the key takeaway is understanding that inherent tension between innovation and financial stability and figuring out how to weigh those factors in your own decision-making process. So here's a provocative thought for you to consider as we wrap up. In a world driven by technological disruption, how much risk are you truly willing to take on a company that shows immense innovation and massive top-line growth, but is still, frankly, far from achieving profitability? Where do you draw the line between believing in a promising future and facing the present financial realities?
Especially when those realities involve significant cash burn and compliance challenges like we've seen here. It's a question every growth investor has to grapple with. We certainly hope this discussion has provided you with some valuable insights today. If you enjoyed this analysis, please remember to subscribe, like, and leave a comment with your thoughts. Or tell us about any companies you'd like us to discuss next time. We really appreciate your engagement and look forward to our next discussion.